Good evening. Welcome back to the Practice of General Insurance class. Today we are looking at chapter 7 and 8. So chapter 7 deals with the rating and premium. In the last we saw underwriting, how the underwriter accepts the business and decides what is to be retained and how it is to be transferred to, so that there's not a heavy financial impact on the company. Now in the course our rating and premium, we will see how pricing is worked out, what is the book rate theory, trends and factors which affect our pricing, the need for coding systems, what is burning cost, the types of market in insurance, what is the practice of premium rates, and 64 VB of the Insurance Act, very important section, a requirement for all insurance companies in India. So when we look at pricing mechanism, the first thing we have to see is our pure premium. What is pure premium? Actual losses, actual claims paid by the insurance company over the years is averaged out based on the number of policies issued against the total amount of claims paid. This average experience that is received is known as the average annual loss experience, or the pure premium. So this is the minimum amount of premium that needs to be charged by an insurance company to ensure that it is cost price. Now to run an insurance company and to manage these funds and to manage the risk, the insurance company incurs management expenses. They have to set up an office, they have to set up staff, they have to have full systems in place. So management expenses usually include salaries, travel and accommodation, and all office expenses like printing, stationery, etc., telephone and all communication expenses. So these are added to the average cost of pure premium that has been already worked out. Then it has to be, has to be sold in the market, so marketing staff are employed, agents and other intermediaries are involved, and for bringing business they have to be paid a cost. So those intermediary costs, that is of agents, brokers, corporate agents, bank assurance, they are paid a commission for the business placed, and this has to be added to the price of premium so worked out. In addition, there are other costs that an insurance company incurs in the process of claims. Where we saw the annual loss was the actual claim amount, the loss amount that has been paid. In addition, other expenses would be there: appointment of surveyor, investigator, other office expenses or special expenses that have been incurred to devise or to arrive at a settlement of the loss. Now these expenses should always be kept within a reasonable amount, but it can happen that in spite of the best efforts, there may be extra expenses incurred. For example, if it is a theft claim, to ensure that it is genuinely a theft claim and not a fraudulent or a claim that a customer is trying to impose, the insurance company may appoint an investigator. Now, depending on the time the investigator takes or where all the investigator has to go, there will be costs involved. So, investigator may bill for all these costs. So, these costs are added and known as claims expenses. In addition, lawyers may have to be appointed, or legal opinion has to be taken, or a specialist has to be called in to check and verify whether this claim is admissible and to what extent, some technical background or knowledge. All of these become part of claims expenses. So the pricing mechanism to arrive at a premium rate, these are all factors that have to be included to arrive at what insurance company will then call the book rate or the rate to be charged. So this in brief was how the practice of a premium price is worked out. The book rate theory. Now insurance requires large numbers. The larger the numbers, the wider the risk of every group, the more closer to a premium rate we could then charge. So what are these components that go to make the book rate? We have seen the premium mechanism, So what we will see here are very much the same things. If an insurance company is in the business of insurance, it is obviously in there to make some profit. So profit is one component that has to also be looked at. If insurance companies don't make profit out of their business, then why will an investor want to come into insurance? Then the component also includes expenses. Now we have seen many of the expenses, the office and other expenses, the claims expenses. All of these expenses are part of the premium component. Reinsurance cost. An insurance company accepts business sometimes or accepts a risk where the value is way beyond its financial capacity. Think of an example of a person earning a salary of 4,000 a month coming to take a life insurance policy for 1 crore, where the annual premium is 2 lakhs. Can the gentleman afford to pay a premium of 2 lakhs? No, because the salary income is only 4,000. So what would happen? It is beyond the cost. Similarly, on the same logic we would apply to an insurance company having a capital of 100 crores and trying to insure for a risk of 1 million crores. If a single loss occurred, the insurance company would go bankrupt. So what do insurance companies do? They retain small amounts. They always try to ensure that they do not take too large a risk. But even that risk, part of it, they will transfer to somebody outside to ensure that they are not impacted financially to a great extent, so they can continue to operate in the market. Fortunately, we have the IRDA as the regulatory authority who makes sure that insurance companies follow a solvency margin. So reinsurance cost is insurance company transferring some of the risk. They have to pay a premium to the insurance company that is accepting their share of business, and that costs have to be added on. Commissions are paid to intermediaries, so commissions are also part of cost. And the pure risk or the pure premium we saw earlier, based on actual loss experience, all of these components go towards first the basis of the book rate. Then we have what is known as a technical pricing. Now this is a mathematical formulas. These are what we say enterprise related. Today with information technology, we can collect a lot of data, and based on that we can have very, very fine rates, provided all data is collected properly. So what is the technical pricing? So technical pricing is pure premium on the basis of first principles. So what is these first principles? These are these are statistical data. So the more detailed your risk data that is available with your companies or insurance companies, the more better it is for them to work out the rates. There are many components that will go to. It is fortunately that today with information technology, we are able to work out better rates and store all types of data so that we could arrive at a proper risk. So what is the first aspect of technical pricing or first principles? Quantitative assessment. So what is quantitative? Statistical data. The detailed statistical data that is available with an insurance company. Let us take a simple example of health insurance. All of you would be familiar with health insurance. You see that premiums are charged based on an age band. Different age bands have different rates. Now to arrive at those simple rates, what would an insurance company have done? So every age band, they would have collected their data of male, female, different parts of the country, what types of risks they have come across, what is the sum insured they are taking, what are the income levels they have, what are their weight, age, height, weight, what medical history. So individual data is captured. And based on that individual data, what claims have occurred, how much are the claims amount, which areas of India pay higher claims, medical costs are greater, what types of hospitals. So all of these are statistical data being obtained. Based on this, so where do the statistical, because each insurance company will have its individual statistical data. But would that be sufficient to work out a rate for the entire country? No. So we look at historical statistical data which is available in the market. Now IRDA is, in the past, the Tariff Advisory Committee used to maintain records of claims and premium and various types of policies issued under all the tariff policies. So every month, every quarter, insurance companies send detailed data about all policies that fell under tariff. And based on that, Tariff Advisory Committee would be able to work out the premium rates on a historical. So they had the historical data and then they gave us the tariff rates. With the Tariff Advisory Committee now not functioning as a tariff committee but only as a data repository under IRDA, so what happens is statistical data has to be forwarded to the insurance company, to the IRDA, and the IRDA collects this statistical data to work out and provides it to all the insurance companies so that they work out they can look at that data and work out their individual premium rates to some extent. So how is that process done? Pattern modeling. So what will happen now? IRDA gives us the statistical data of the entire insurance industry in India under fire, under marine, that's marine hull, marine cargo, motor OD, motor TP. Within those patterns we see various, how much is the premium, how much is the claims paid. So working on those patterns, an insurance company looks at whether their premium and claims experience is similar to this national data or is it differing. So when there is a difference, why is the difference? It could be because of underwriting practices, it could be because they are careful about the risk, or if the differences are heavily loss-making, more towards losses, then obviously there are some problems in underwriting or acceptance of risk. They are not being careful. So companies look at these to work out their pattern. There's another element which goes into pattern modeling, and that is for delayed claims. What do we mean by delayed claims? Long tails. When you hear the word long tails, the first thought that will come to us is liability insurance. A liability insurance means a legal claim which will go through the courts of law to decide whether a claim is admissible or not, and the court will decide the amount of compensation that is to be paid to the person. Look at motor third party. The accident took place in 2010. The third party is claiming today in 2013. So it has, the insurance policy is already over. This is the third year running of the policy, but the insurance company is just getting information about the extent of the loss that is being claimed by the person injured. So this is a long term. Sometimes it can go even to 8 to 10 years before the claim comes up and the decision is taken. So insurance companies have to provide for long-term tails or liability losses which take many years, because courts take a decision, they don't take a decision overnight. It takes years. There are presentations from both sides, the plaintiffs and the defendants, and thereafter a decision is taken. So that court case itself can go to 5 to 7 years or maybe more before an insurance company will know how much is finally the loss. So they have to provide for that. So an insurance company which has a large amount of liability business would have to be very cautious and make provision for liability claims which would be long tail, which would not come to their knowledge immediately. The other aspect is an insurance company makes a provision. That means they keep aside a fund from the premium towards those claim settlements. Now those claim settlements fund is not kept at home, at the office. It is kept in a bank, but not in an ordinary current account. It will be invested in various risks as permitted by the law. So those investments will earn a return. There will be some interest earned or some revenue generated from that money. And those reserves, income being earned, has also to be adjusted for the loss. So indirectly an insurance company from the reserve returns, they will reduce their provisionings in that manner. The third element that will come into pattern modeling is catastrophes. We have observed now of late, in the last 3 years, we have had major losses. There are cyclone losses, there are major earthquakes. Now if insurance companies are impacted by that, where they have had to pay loss, and on large scale, it becomes a catastrophe. So those events, if they are happening more frequently, an insurance company has to provide. In the past, we rarely heard of earthquakes. Earthquakes would occur maybe once in 8 to 9 years, but now we find earthquakes are taking place regularly all across the world, and lots of property damages are taking place. Similarly, flooding is happening. We talk about climate change. All of these are happening and having an impact on insurance and losses. So catastrophes have also to be provided for. So what will happen from the statistical data, insurance companies will work out how much claims are being paid for catastrophes and what sort of provisioning they should make there. So the actual loss experience versus the exposure. So I have 1,000 policies, policies insuring various factories where my total exposure is running into thousands of crores. But my claim experience is only 10%. So loss experience versus exposure. How much business I am insuring, how much assets I am insuring, and how much claims I am paying. So normally, the major expense for an insurance company is the claims. So that loss experience or the total claims payout is what the insurance company will look at as against what is the business they have insured. You would have all heard that motor third party is a loss-making experience. What does it mean? That looking to the exposure, the losses are more than the exposure because of motor third party. So we see that insurance companies have to look at further improvement on their underwriting practices or trying to reduce the losses. So based on this, a pattern or a mathematical formula or some models will be created from which an insurance company will then work out some rates. So this was based on all historical data, on quantitative assessments of statistical data in existence. But we have to provide for what is the future too. Look at the changes that have taken place in the countries across the world. We have moved from agriculture and manufacturing to a service industry. We have moved from single homes to 3 and 5 story buildings, and now we are looking at towers of 20 and 50 stories high. So risks have changed. And because the risks have changed, insurance companies have to work out a new model. The other element is what types of risk have come in. We are in the service industry, manufacturing is reducing. So the risk of what we had statistical data of manufacturing is no longer acceptable for the future because we are now looking at intellectual power deciding futures. So in intellectual powers, income levels have changed, people's food habits have changed. All these are impacting us in the future. So today what happens? TB, smallpox, they are not what is the normal. Typhoid, these are not normal claims. Our major claims in health insurance are now coming from people who have heart problems, diabetes, hypertension. So lifestyle diseases have changed. So we have to provide future that things are changing, how to provide for that. So we can't be astrologers. We can only work out based on statistical data and look at thinkers to give us some ideas. And that is how we work out our technical pricing. So this is much more complicated. Most insurance companies follow the slide of standard premium, which we will now look at. What are the trends impacting our premium rates? Inflation. All of you have felt the impact of inflation. You are feeling it today, where vegetables and normal day-to-day necessities would be 20 rupees a kilo. Today you think of 100 rupees a kilo for the same things. So prices, inflation is not at all consistent. It could be anything, different things depending on demand and supply, inflation is working havoc. So we have to even provide for that. What type of risk we have? What type of inflation indexation should we give for that risk? So premium has to be worked out. Then political changes. So terrorism now is a major risk for all of us. And terrorism can hit anywhere. So we have to look at. Then there may be government policies or government practices which make a risk better or which increases a risk. It all depends on the circumstances. So sometimes laws may result in social losses. Sometimes laws may result in better or secure risk. So all of these impact. We have to provide for these too in our rating processes. Technology has made a major change. It's because of the technology today we can reach you all in so many places. We are not restricted to the four walls of a classroom. So many of you across the country and outside Asia and Africa are also tuned in to this one because of technology. Now what has technology done? Robotics. Technology also makes it possible for providing for taking away the previous manual errors. Manual errors caused losses. When the human element is involved, major losses take place because of human negligence, human deficiencies. So manual involvement is getting reduced. Machines are doing most of the thing. If you have programmed your machine well, it will give you good service. It will give you what you want. If you program it badly, it will have an effect. So another element, because of technology, safety measures, greater safety measures can be taken. You have closed-circuit televisions, you have closed-circuit TV, you have burglary alarm systems. All of these help in mitigation of some risk. They also have increased other types of risk. So somewhere risks are reducing, the exposures are reducing, sometimes it is increasing. So these are all technologies, the technological impacts which also we take into account in our rating. Then the legal changes. Legal changes have impacted us badly in motor third party. In the past, motor insurance, if injuries to persons, if a vehicle injured a pedestrian on the road, compensations would be about 50,000 to 1.5 lakhs. Today we look in crores. So costs of litigation have gone up, judgments are also high, and so insurance companies have to make provisions for such liabilities. And as we move to service industry, as our major wants are satisfied, there will be more and more legal cases where people seek compensation because service was not up to the standard that they were required. So these are all extra costs that an insurance company provides for. The other element, as our income levels grow, many of us want to show that we have arrived in society. We don't want to show that we belong to small towns. We want to show even though we are from small towns, we can afford the best and the latest fashions. We can have the best furniture and interior decorations for our homes. So what has happened today? Style. So you will find that each stage as your income grows, every customer is looking to show that they are better than the rest. We want to show that we have arrived in society. When everybody is buying the same thing, then there is no fun. So today in cell phones, the iPhone, and now you find everyone has a tablet. So where is it? So it's become a commodity. Everyone holding it, there is no pleasure. I want to be different. So that element that every human being wants to show that we are better than the rest, that also has an impact on the risk. So what you find, where in the past our parents bought a car and they believe that will be for the rest of their life, they will use the car. Today you and I don't look at it that way. We look that after 3 years, oh, this model has become old. Let's change it. So we go for the latest model. And the next, after 3 years, it's another model. Now how do we do it? Because banks give us loans, so we go for it. And so the attractiveness, style statement. So Maruti car, oh, it's standard now. Let us look at a BMW. Or let us look at something greater, a Rolls-Royce or a Bentley. So each one has to show that. So this is all part of trends which affects our insurance premium. And simple example, would you like to be seen in an ambassador car? No. So you see the changes that have taken place. We want the latest models. We want the best. The other impacts, The major impact we all hear about: global warming, climate change. Is it affecting us? Yes, because storms are getting more severe, heat is getting more high, it is getting hot everywhere. All of us need air conditioning today. We can't do without air conditioning systems. Even in a small little home, a simple air conditioner will be brought. It's too hot to live. Climate change has brought in. Now when we bring air conditioners in the home, what is the chances? Do our electrical systems take that load? No, there'll be a short circuit, and because of the short circuit there will be a fire, and we'll find we have destroyed. So there is where we need insurance. So climate change is coming, global warming is coming, economic changes are taking place also. Income levels are growing, we can afford, more family members are working, and everybody is looking to better themselves. So what happens? New risk, new generations, new items. All of these have to be provided for. Insurance company knows that we have to forget the old. We have to see new and how it will affect us, because we have to pay the losses if the events that occur. So the trends that impact our rating we are seeing. We now move on. Worldwide, they have coding systems, because information technology has helped us to do this. Codes. So every risk. Now, for example, third-party administrators are found only in medical insurance. The purpose why we have introduced third-party in medical insurance, one is that the premium and the exposure is great. All across India, there are claims coming in. After motor, health insurance is the major premium portfolio of an insurance company. So IRDA is bringing some standardized international codes to recognize different types of sicknesses. If these codes are in place, it becomes easier for us to track all the types of losses we are paying, whether it is an open heart surgery, whether it is a laparoscopic surgery, whether it is a brain tumor, whether it is a kidney failure, whether it's an organ transplant. Detailed descriptions of each and every code systems can be in place. So what is happening? So this class, we can divide them into such detail that we can work out, standardize across the world, a standardized rating formula. Then only we will be able to give very fine rates. What we look at in these coding systems, from this data we will say how frequently is these losses happening. So how many bypass surgeries are taking place? Of the total, what is the cost involved? Is the price too excessive? Across cities, what are the standard rates that are being charged? So we have an idea of how frequent and how much is the loss payouts. So insurance companies can work out specific rates or put in some clauses. For example, in medical insurance, cataract operations, previously it was an open. Whatever is your bill, insurance company paid for the cataract surgery. Today they say we can put a cap, that not more than 25,000 or not more than 50,000 per cataract surgery. So what has happened? They are finding the frequency too much, loss ratios going up, which means the premium will have to go up. So rather than increasing premiums too high, they put caps so that it will control the loss. So premium data also can be worked out, age-based, individual ages, and all those basis premium data. Claims data, all that goes into the coding systems. So we can work out exposures. So mathematical formulas, there you see analytics, the importance of analytics. Now internationally, every type of industry, manufacturing, service, the International Labour Organization, which is part of the UN, has laid down some coding systems. We in India are also following this kind. We call it the National Industrial Classification, which is similar to standard industrial classifications of USA and Europe. So these are the practices that are being followed across the world, and we are trying to arrive at standardization of data so that finer rates and much more premiums could be targeted at particular different risk. We need not have a standard rate across everybody. So good features brings better rating. Bad features means the persons will have to pay higher premium. So code systems can all be done because of analytics, because of information technology. The standard practices insurance companies follow in premium rating. We saw the technical rating. Very, very difficult thing. So insurance companies follow the concept of burning cost. What do they do in burning cost? They work out the last 5 years claims experience of that category of risk. They average it out. So 5 years claims data is taken out and averaged out. So we work out last 5 years average is this much. Then we adjust it for all these technical trends, mainly inflation and any other technical trends like catastrophes which we want to look at. From this now we have our basic cost or loss that we can look at. Now this next aspect for us is to look at how much insurance we have placed, how much is the total insurance we have, that is the total loss exposure or the total value of policies which are insured. Those are also averaged for 5 years. So based on that, we adjust the claims, the average claims. We have already worked, we have averaged by the average exposure, we will get a premium rate. Now to this premium rate, we make adjustments for our loss experiences, whether they are similar or different. Discontinued features. What are discontinued features? Insurance policies are changing over the years. So some features which were in existence before no longer there. So those discontinued features will no longer impact in the future. So in that case, we have to reduce our losses based on those because these features no longer exist. Liability impacts, the changes that have come in and how much are the losses we are having to pay. Similarly, earlier we may have not insured them in the past, today we are insuring. So simple example, fire insurance, most clients would take a basic fire insurance covering just fire and lightning. Those who were exposed to earthquake would take earthquake add-on. Those who were on the coastal regions where they face cyclones or storms would take the wind and storm perils, wind and water perils extensions. So they would take according to what they felt was. Today we have a fire policy which has all these features inbuilt. So earlier which they were not being covered are now being covered. So everyone could be filing a claim for these losses, which was not the case in the past. So all of this impacts and we make the adjustment. But what is the problem with this burning cost method? It is a retrospective rating. We are looking at past, we are not looking at future. So based on our past experiences, we are working out losses. The past will just give an idea, it does not remain continuously throughout. So we have to provide for future, and that is why analytics requires looking at the future modeling also. So how do this burning cost adjustment get made? Now when we look at the burning information of claims, invariably claims will be of two types, paid and outstanding, because claims don't get settled within 24 hours. So a claim made in the last month of the financial year may be settled in the next financial year or maybe the following financial year. So that it will be an outstanding provision. Now the difference between what was provided for and what was settled may be less or maybe more. So that also impacts. Turnovers are changing. Think of the time when a company would make maybe 1,000 pieces of our item. Today with technology, we are making 1 million pieces. So changes have been. The other important element is in the past, a customer stayed with an insurance company for years. Today, every year they change an insurance company. So how can the insurance company get the records of previous years from another insurer? It's not possible. So they have to work out some sort of an provisioning. If losses are increasing or decreasing, they have to provide for that. A large loss may not happen every time. It may be a one-off. So large losses, we can't look at a large loss impacting this year would be the same next year. It may not happen. There was one Bhopal. After that, there has not been. So we need to show that one single loss may not impact. So we have to provide for that. And we saw outstanding claims. So provision of outstanding claims, the accuracy of the reserving. Very, very difficult because it is going on historical. We have to look at future. Risk improvements. Construction, building constructions have changed from mud huts and mud homes and stone and brick. We are now going to RCC. So those are major changes. Even the coverage that insurance companies offer today are a lot different from what it was in the past. We've seen we are moving from manufacturing to service. So manufacturing risks have become less. We are looking now mostly at offices and insurance of offices and technological equipments. Factories are very rare, and even if the factories are there, invariably these are processing units, small little units where processing is done. Everybody is outsourcing, so the risks are smaller. You would not have a factory today of Hindustan Lever, which used to manufacture everything within its own factories. Today it outsources a lot of the work. So all of these have an impact because now the risk is become smaller. The property insured is smaller because of the outsourcing, but then the risk may be greater because an outsourcer may not take as much care about his property. So different improvements and changes. Then laws are also changing. Laws are making a number of things compulsory. Laws are requiring certain security features, certain safety features to be introduced. Inflation is not stable. It is changing across different categories. All those have to be provided for in adjusting for our burning cost. And then the most important cause, where the burning cost is not suitable for small risks, because we want large numbers so that we can work out. If there is just 100 properties to be insured of a particular type of risk, the rates will be very, very high because the few risks. So if we are looking at 1 crore properties of the similar, then we can spread it across a larger. So burning cost rating is more suitable when we have large numbers. So that is why if any of you are working in your insurance industry, in your operations, in every aspect, please make sure all your statistical data you fill in correctly. Because in the long run, that will make your company profitable and it will give you benefits. So you can enjoy the benefits of bonuses only if you bring as much data to your organization so that the organization can be competitive in the market. What are the markets? We have 2 types of markets, soft markets and hard markets. What is a soft market? Soft market is when insurance companies have got a lot of capacity, they are willing to take on any risk. They are willing to give new covers, they are willing to reduce the premium at very low rates. Why? Because their loss ratios are very low, so they are willing to take on some more risk. This is the time when you can get more premium, expand your market, bring in new customers at a time of a soft market. So capacity available. So there's many of insurance companies, all of them have capacity and they are willing to share. So what is there? Each one will try to compete with each other, the lower rate, bring more premium for them, because more premium means more reserving can be provided, more investment income will be generated, and the results of an insurance company will improve. So they will achieve their profit. But what happens? A limitation. Because of this soft market, there's price cutting. They keep on going to prices to so low that at some point of time, the price will be so low, it will be less than the losses that they will see. So the losses rates become so unsustainable that at some period of time, the losses will exceed the premium received. So you will see motor third party, health insurance, they are all loss-making businesses because undercutting and premium rates have gone so low. Previously in the past, because of tariffs, insurance companies had subsidizing of fire insurance would subsidize other motor businesses. Today that is not possible. So what is happening? A soft market means at some stage price cutting will take place, unsustainable rates will come in, increased losses, and then we will be moving. So the cycle changes. It moves to a hard market. Now the premium rises. Insurance companies reduce the cover. Why? Because they know that they can't bear these losses. Finally, they will have to get rid of many of their fixed assets, which is a problem. So what will happen? The risk gets, insurance companies put more and more conditions in the policy. Their rates are now very, very commercial priced. Only if it's a good client, they may offer some discounts. Otherwise, they will raise the premium, reduce the covers, put additional conditions. All these are part of a hard market. The practice in the insurance industry in India for general insurance, Premium rates in fire insurance are usually at a per mille rate. Per mille means per thousand of sum insured. And these are also further classified into different types of trade, different types of processes. So classifications, various categories of risk, of various types of processes will have different rates. In marine insurance, the premium is usually a percent on the insurance value. Whatever is the value taken for insurance, on that a premium rate at percent will be charged. Motor insurance again is a percent rate on the value of the vehicle. The class, type and zones are taken into account. In engineering, the rates are always per mille, per thousand of the value for what insurance is required. And in miscellaneous other branches, it could be a per mille rate, it could be a percentage rate, or it could be a per capita, that is per person rate. So different types of risk, depending on the types of policy, the different rates would apply. When we deal with insurance premium and rating, we must not forget a very important section of the Insurance Act, and that is 64BB. Unique to India. According to the section 64BB, no insurance company can insure a risk without first receiving the premium. So premium has to be paid in advance. Worldwide, the broker normally would pay the premium and the client would be allowed to pay it after 2 months or 3 months based on the agreement between the insurance broker and the client. But in India, we are very specific. Premium has to be paid in advance. Payment can be made by cash, by check, by a deposit, the cash deposit with the insurance company, by a bank guarantee, normally given when the premium rate cannot be worked out because an inspection is required or for some other reason. So a bank guarantee is given, but that again has to be, the guarantee has to be converted into a check or a payment within a month after the guarantee is given. Credit card payments are also permitted. Postal and money orders also can be sent. What is important is an agent is not authorized to receive premium. So if an agent collects the premium, it is not binding on the insurance company. So when an agent collects the premium, the agent must deposit within 24 hours. Failure to deposit means insurance company is not on risk. Agent cannot be held liable because the agent is an intermediary of the insurance company. So it must always be told to agents that any check or any payment they receive in premium, they must deposit it in the office within 24 hours or the next working day if a holiday comes in between. But never allow them to keep it overnight for too many days. Problems could arise because if premium is not received by insurance company and a loss takes place, insurance company will not pay. A policy has been taken, the client cancels the policy or reduces the sum insured, a refund has to be given. So refund cannot be given to the agent, it has to go directly into the insured's account. So today the trend is to direct credit to the client's bank account. So this 64BB is a vital element of insurance premium rating. So we've seen the premium rating practices, how premium is worked out, the various types of premium in this session.